Crypto doesn't need safe havens, it needs safe markets. Crypto has never needed safe havens. It needs safe markets. The difference is more than semantics. A safe haven is a place to hide. A safe market is a place to build. Jurisdictions that understand this distinction will be the ones that capture the next significant wave of serious capital. The crypto industry has been in a regulatory tug-of-war for over a decade. On one side, innovators argued that too much oversight would suffocate the technology, while skeptics warned that too little would expose investors to catastrophic risk. The collapse of crypto exchange FTX in November 2022 only widened this divide even more. Caught in the middle, many crypto businesses took on a simple playbook. They found the jurisdiction with the lightest touch, grabbed a license and called it a win. This safe haven strategy created short-term advantages for many of those companies. It allowed exchanges and token issuers to scale quickly, avoid tough questions and brand themselves as pioneers. Outside of the US and therefore, outside the reach of Gary Gensler, former chair of the U.S. Securities and Exchange Commission (SEC), and industry boogeyman known for his regulation by enforcement approach to crypto, many of those companies likely felt relief. But it also produced exactly what critics feared. Markets where investor protection was an afterthought, enforcement was inconsistent and credibility was fragile. The result is a trust deficit that still weighs heavily on the industry today. The United Arab Emirates, UAE, has nailed the delicate balance in regulating crypto, carefully walking the line between innovation and safety. Instead of rushing to become a permissive playground, the country took a slower, more considered approach. It invested in a comprehensive regulatory framework, launching entities like the Virtual Assets Regulatory Authority (VARA) in Dubai and the Abu Dhabi Global Market (ADGM). The UAE's goal was never to attract companies looking for shortcuts, but to build an ecosystem where safety and supervision are the primary focus. This matters because capital behaves differently today than it did in crypto's early years. Retail traders may have chased offshore exchanges and high-risk offerings, but institutional investors are motivated by an entirely different calculus. Pension funds, sovereign wealth funds and family offices are gravitating more and more toward markets where strategies have been tried and tested. They allocate capital in jurisdictions where they can trust the rules of the game, where custodians meet international standards and where enforcement is legitimate, that is, where laws and regulations are applied consistently, fairly, and transparently. By positioning itself as a safe market rather than a safe haven, the UAE is sending exactly the right signal. Innovation is welcome, but accountability is non-negotiable. The UAE's multi-layered regulatory environment gives crypto businesses the choice of which regulatory framework suits their operational needs. This is a reflection of the UAE's ability to support genuine innovation and healthy competition through transparent frameworks and world-class regulatory standards. It's further evidence that the UAE is evolving beyond minimum compliance, creating an ecosystem where capital, talent, and fresh ideas not only converge, but thrive. The idea that a weak regulatory framework could be an asset for the crypto industry is losing traction fast. In fact, the opposite is now true. Loophole jurisdictions are becoming liabilities. Global regulators are closing ranks, sharing intelligence, and applying pressure on markets that undercut standards. The International Organization of Securities Commissions, IOSCO, which sets the global standard for financial markets regulation, has increasingly focused on crypto markets in recent years. At the same time, retail investors are more cautious. The high-profile collapses of exchanges and lenders in recent years have reminded everyone that when the rules are unclear or unenforced, it is the investor who pays the price. Markets that rely on being easier are already getting called out publicly. Malta was recently criticized by the European Securities and Markets Authority, ESMA, for not conducting enough due diligence before granting a license to a crypto firm. More recently, Malta pushed back on the push for centralized European crypto regulation, with the local securities regulator saying it doesn't support regulatory centralization. Being known as a regulatory arbitrage hub may have worked in 2017, but in 2025 it is a massive red flag. The next phase of crypto adoption will be defined less by speculative trading and more by integration into mainstream finance. That means stablecoins backed by real reserves, tokenized assets with clear legal protections and exchanges that can withstand the scrutiny of institutional due diligence. This is why the safe market model is more powerful than the safe haven model. It aligns with the interests of long-term investors, creates durable trust, and ultimately raises the bar for the entire industry. Crypto is often described as borderless, but capital is not. Money flows along channels of credibility and regulation. The jurisdictions that recognize this will become the winners. They will not be the places where oversight is weakest. They will be the places where oversight is most effective. Safety is not a barrier to innovation. It is the foundation of growth. The UAE's example should challenge other markets to rethink their approach, not to chase companies with lax rules, but to attract them with robust frameworks. Crypto doesn't need more havens to hide in. It needs markets strong enough to support its ambitions, transparent enough to earn trust, and safe enough to scale. That is where the next wave of capital will go.